Welcome back to another video on liquidity. To start, I'll quickly go over what liquidity actually is. So, what I've drawn here is a basic bullish price leg, where we've put a high in, a low, and we've moved higher. Like I'm drawing out now, most people would buy once we break the previous high and put their stop just below the low, like I've done here, with their take profit somewhere up above. In reality, what actually happens is price comes back down, breaks this low, and then there's the big bullish move. This is because large institutions need lots of sell orders in order to place their large buy order. So they drive price down and trigger all the stops, which are the sell orders, which is why I mark them as liquidity on the chart, in order to place their big buy order, which is the bullish move that follows the sweep of liquidity. This simply means liquidity is where there are lots of stop losses. Okay, so moving into our first example, as you can see here, there's a big low, so we draw out our liquidity just below it, as this is where all the stops are going to be for people going long. Then, as you can see, we have our aggressive move that sweeps this liquidity and quickly goes back into the range, which I'm marking out now. As you can see, as soon as this liquidity is swept, price goes bullish and goes up as this line's showing. Now, I'll show you how to validate a liquidity sweep and make an entry out of it. So, like before, we mark out a manipulation leg, but this time we also mark out the previous high. What we're going to do is we're going to wait for this high to be broken, causing a market structure shift, and then we take our entry, as we know the liquidity sweep is having a reaction. So, we place our entry on the close of the candle that causes the market structure shift, and then we look left for any potential targets. We see one fair value gap here and another fair value gap just above. The next thing we do is we look for an area to put our stop, and we're going to put it just below the low that's formed here. Now that we have our stop placed, we can't place our take profit on the lower fair value gap as the risk to reward would be too low, so we target the upper one for a nice risk to reward of about 2.65. So there was a sweep of liquidity, we entered off a market structure shift and targeted a fair value gap for a nice trade. Now we'll look at why waiting for a market structure shift might be a good idea. So we mark out the key liquidity, which is above this high, as there's stop losses from people going short. Next, we identify the aggressive move that swept this liquidity, which is seen here. Now the next step, usually, will be to wait for the low to be broken, which I'm drawing out here, which would cause a market structure shift. However, this never happens. Instead, price goes bullish, so we save ourselves from a losing trade. This is why waiting for a market structure shift is useful, as it helps confirm the liquidity sweep. On to the next example, we mark out our liquidity, which is above this high, as people's stop losses will be there who are going short. Next, we mark out the move that sweeps the liquidity, which is seen here in the blue rectangle. Then, we'd wait for a market structure shift to confirm the liquidity sweep. So, we'd wait for this low to be broken, or, to be safe, we can wait for the major low below to be broken. If we decide to be safe, we wait for the market structure shift on this major low. Then, we place our entry on the close of the candle that causes the market structure shift, like so. Next, we look left for any targets, and as you can see, we have a fair value gap. We decide to target the mean threshold to maintain a good risk to reward ratio. Then, we move our stop just above this fair value gap to get a nice risk to reward ratio of about 2.42. To finish off the video, I want to talk about how this can link to accumulation, manipulation, and distribution strategies. So, to start, as you can see, we have trendline liquidity building up in the Tokyo session, which is where highs are put in a line, like seen on the screen. Then, we also have a swing high, which is where people's stops are for people going short. And then, like usual, we draw out a manipulation leg, which sweeps the liquidity and closes back in the range, which I'm drawing out here. And then the next step will be to wait for a market structure shift, which would involve this low here being broken, which I'm drawing out now. This low is broken, but it's by a very big candle, meaning it could be news, and it's only closed over by a little bit. So instead, I'm going to wait for the next low to be broken, which I'm drawing out here. Then, when price does eventually break the low, causing the market structure shift, we place our entry on the close of the candle that breaks it, with our take profit on these liquidity zones that I draw out here, and then we look for a place to draw our stop, and we see a fair value gap, so we place it above there for a nice risk to reward ratio of 3.46. If we want to be a bit safer, we can move our target upwards to the middle liquidity zone for a smaller risk to reward ratio but a safer trade. That's about it for liquidity, so thanks for watching.